We keep hearing this narrative in Washington about, the Fed's got to cut rates. No, it's all on the commercial side. It's commercial real estate, private equity, private credit. This is where the pain is right now for banks.
Hey everyone, welcome back to another episode of WSJ's Take on the Week. I'm Telis Demos.
And I'm Miriam Gottfried. Today's show, a big conversation about banking and lending. But before we get to that, let's do what we always do, give our takes on the hot topics for the coming week.
Nothing hotter than gold right now, right?
That is true. In fact, gold reached $4,000 per troy ounce on Tuesday and kept trading above that.
So on the last episode of this show, we talked about this idea called the debasement trade, which is essentially that the U.S. dollar is going to be debased by inflationary things, and that means that people want to have an inflation-proof asset, diversify away from the U.S. dollar, and that's into gold. But some people are kind of poo-pooing the idea that is exactly what is driving this trade. In fact, a former guest on this show, Ed Al-Husseini, who's at Columbia Threadneedle, he was saying the debasement trade idea, just wrong, that's what's driving it. And I think that was laid out a little bit by our colleague James McIntosh, who wrote in his column that, if debasement is about inflation at its core, then he said debasement fears seem to be everywhere except the one place where they should be most obvious, bonds. And by that he means that
Interesting.
30-year treasuries, for example, which normally should price in a lot of inflation risk, haven't really moved. And so if you're not seeing that fear there, why are you seeing it in gold?
I think there's just a general feeling of nervousness that's creeping into the market. And maybe that's what's driving it. A lot of the gains that have happened in the stock market have been powered by this AI trade. And there have been a number of indicators recently that some of the assumptions that have been underlying that may have been overly positive. For example, Oracle, which had a huge stock move when it announced this deal with OpenAI a few weeks ago. It's kind of cooled off a little bit since then. And I think that might be people realizing, maybe some of this stuff is just kind of like pie in the sky numbers that may not pan out.
The chief economist at Vanguard Group, he was quoted in one of the journal's recent market stories. And he was saying that what he thinks you're seeing are basically people pricing in divergent paths for the AI trade. On the one hand, AI is transformative and either delivers, enormous productivity and efficiency benefits for lots of companies, or there's been an overinvestment and overbuilding and overhyping, and that will crash. So eventually maybe these things will all pan out.
It may be overvalued now, but still,
exactly.
Going to be revolutionary in the future.
And so that gold represents basically a bearish view on the stock market and not necessarily something about currency debasement and inflation. Bill Silber, he's an economist, longtime NYU finance professor. He called gold essentially a form of catastrophe insurance that people are buying. There's also, let's be honest, there's my neighbor's buying gold. Maybe I should get some gold too. There's the momentum element here as well.
Got to start stockpiling.
Though interestingly, all right, so gold, in addition to being a speculative instrument, is also like a thing that people want, right?
It's beautiful.
Has been for centuries, for millennia. But in Q2, the World Gold Council was talking about declining jewelry demand around the world, particularly from China. I checked an index that tracks Rolex prices, and the average price for the top 30 Rolex models had actually declined recently. So if gold jewelry and gold objects are not in as much demand, maybe that's telling you that there is something really speculative happening in the gold market.
And defensive, right? Like luxury spending is something that people do when they're feeling good about the economy. And hoarding gold is something that they do when they're nervous, I think. I think those two things are different, even though they both involve gold.
Yeah. So the gold trade will continue to, I think, dominate conversation for a little while. But in the meantime, we have do we have economic data coming up? Is that a thing that's still happening? Are we going to keep doing
It's a big question because the government is still shut down as of this taping. We don't have the jobs data or it's been delayed. And in the meantime, some private sources of data have attempted to fill the void. We had data from Bank of America. We had data from Carlyle Group, a firm that I cover, a private equity firm, which was trying to extrapolate employment data from its own portfolio companies.
I actually thought that was pretty interesting because Carlyle Group, being a private equity firm, owns hundreds of companies. Those then employ hundreds of thousands of people. And they actually came up with a September payroll number based on what they saw in their portfolio. They said that there were 17,000 jobs created in September, which was slower than in previous months. So that indicator says that the weakness that we've seen in the labor market is continuing.
But the question is whether the market really trusts these alternative sources of data. Like, can we live with this, or do we really need the real data? I mean, a lot of this stuff is also kind of extrapolated using government data. And if we don't have the government data as our typical guidepost, will we be able to continue without it? And I think it could also be fueling the uneasiness that we're talking about among investors. Like, if I don't know if this AI trade is going to pan out, and I don't really know if I can trust the data that I'm hearing, and we have a dysfunctional government that isn't able to, operate right now, maybe I'm just going to buy some gold just to be safe.
Yeah, and I don't think that there's a widespread trust yet of the private indicators to really replace government data. We had our guest Dana Peterson, the chief economist at the Conference Board, was on a few weeks ago, and she talked about how government data remains the gold standard. And Conference Board has been producing economic indicators for a long time, but the government data is a necessary benchmark. So I think you're right. I think that there is uncertainty in the face of not having this data. But in this vacuum of government data, one place people could look for at least economic tips, arrows, this upcoming week are bank earnings. U.S. banks, of course, are giants. They lend to hundreds of thousands, if not millions, of companies and people. And what they say in their quarterly reports might point us at least in the direction of what's going on in the economy.
Yeah, I mean, we could look at credit delinquencies. We can look at their loan performance. There's a lot of important data that comes out for the banks that people keep a close watch on, which is why we cover the banks so carefully every quarter here at the Wall Street Journal.
It's been an interesting year for banks, too, because we've really seen a divergence between the stock price performance of the very biggest banks, that's your JPMorgans and Wells Fargos of the world. Those stocks have been doing very well, whereas smaller regional banks, those stocks have not been doing very well. And that tells us a few interesting things. One of them might be something about what's going on with consumers versus businesses. The big banks really have giant consumer businesses. They are huge credit card lenders. Smaller banks tend to be a little more weighted towards companies, middle market companies, for example. So maybe that's telling us something about the way people feel about the economy. And in the conversation we had earlier this week with our guest, Chris Whalen, a longtime bank analyst and chairman of Whalen Global Advisors, we talked about how actually he's seeing more concern in the companies, in the commercial side of banks' businesses than he is in the consumer. And I thought that was pretty interesting because we talk a lot about, what's going on with credit card debts and are people spending and things like that. We don't talk so much about what's happening in the business side of the economy.
I can't wait to hear more of that conversation. That is coming up in a bit.
Welcome back. We're here with Chris Whalen. He is a longtime banking analyst and chairman of Whalen Global Advisors and also editor of the Institutional Risk Analyst. Chris, welcome to the show.
Thank you.
We talk all the time on this show and in society in general about, the significance of the AI trade and how important technology stocks are to the S&P 500. But what people might not know is what the second most important group of stocks are, and that's financials. They are the second largest sort of weighting in the S&P 500, and financials have not been performing quite as well as the rest of the market this year. They're up as a sector about 11%. The overall S&P 500 is up about 15%. Infotech stocks, by the way, just for context, are up around 24-ish%. So what's happening? Why are financials, the biggest of which are the banks, your JPMorgans and Bank of Americas and Wells Fargos of the world, why do you think this sector's overall been kind of underperforming the market?
Well, the broad sector, if you include all of them, we look at the top 100 banks in our work. is fairly modest. They're barely making 1% return on assets. They don't have a lot of demand for loans. So as you can imagine, the demand for the stocks is really a function of earnings.
So what's different about those very large banks? And I know that, JPMorgan, Goldman Sachs, Morgan Stanley, a lot of those banks have beaten the market this year.
Yes.
So what's going on with the biggest banks?
So all of these models are different. It's a coral reef. None of these banks are the same. JPMorgan, enormous institutional investment shop, but also half bank. So they tend to benefit really in just almost transcendental terms because their costs are 10 points lower than the rest of the group.
You raise an interesting point about how some of these biggest banks have these extremely diversified businesses. And we know that the Wall Street units of these biggest banks, their trading desks, have done extraordinarily well with all the volatility happening, all the things that have sort of maybe slowed or impaired the economy, uncertainty about tariffs, immigration policy. Those things have roiled the markets, and a lot of things are up this year. And so that's been good for those banks' trading businesses. So can banks essentially perform well even if the economy is only doing okay or even not very well? Are they so diversified that they're almost telling us something totally different about the financial sector versus the real economy?
No, I would say management focus and business model are still very important. The business models in all of these institutions are very important to understanding how they're going to do and why. Synchrony. It's a white label credit card business. They have a gross spread, which is their total earnings off loans of 20%. That's almost twice as much as Citi. High risk business, but they make a lot of money.
And a white label credit card business means that they provide, if you have a card from a retailer,
yes,
that is, you use it in their store.
That's right.
That card is not the retail company. So how is that credit card business doing amid everything going on in the economy? What's your outlook for the credit card business?
The default rates are low. The credit costs are low. So far, so good. What everybody's worried about, what we've been waiting for several years, is that consumer recession. But it hasn't happened.
Right.
If anything, the banks have been releasing credit reserves all year. In fact, they were up statistically in the second quarter because of Capital One buying Discover. Other than that, the numbers would have gone down a lot. So you have this really weird situation where everybody thinks the consumer is hurting. We keep hearing this narrative in Washington about, the Fed's got to cut rates. No, it's all on the commercial side. It's commercial real estate, private equity, private credit. This is where the pain is right now for banks.
It's really interesting to hear you say that you're more focused on problems in the commercial side of banking than the consumer side.
Yes.
Because I think we can all think of stresses on consumers. For example, interest rates on credit cards are very high. We know that the labor reports have not been as strong lately. But what is happening on the commercial side? Because it seems like in a lot of cases, businesses have been doing pretty well. They just got an extension of big tax cuts recently. So explain why you think we're seeing that pressure on the commercial side of banks' businesses.
One of the big pain points for lenders and also for funds has been private equity.
Okay.
There's an enormous amount of credit exposure inside of private equity, and many of these companies can't be sold at nearly the valuations that the private equity manager pretends that they have.
So this is a private equity firm. It took a company private a few
That's
years
right.
ago. Now it needs to resell it. But
That's
you're saying
right.
they're not getting the price they want, and so they're sort of stuck with this company.
And they have investors that they put into that asset. So what you're seeing is that there's kind of a churn in private equity, and there's also bank loans to these companies that often have to be written down. The other big thing, I think, since COVID has been commercial real estate. There has been an episodic change.
That's
office
malls,
buildings,
office buildings,
and apartment buildings.
That's
right.
Healthcare facilities.
That's right.
Okay, yeah.
And these are assets that for 60, 70 years before were always going up in value. And that meant that every 7 years, the developer could refinance the building and take cash out. It was a source of capital for him to go off and do something else. Today, you're lucky if these valuations are stable. In many cases, they're falling. So I think that there's still a lot of question marks in terms of what these assets are worth. And a lot of banks are being forced to write down loans on commercial properties that they may have made during COVID or a little before. These are typically 7-year loans. So once they come up, what happens? The bank looks at the property and sees that it's gone down in value. They don't want the building. They don't want to foreclose. So they often will modify the loan or really just provide forbearance. And one of the interesting things is that the regulators have recently made changes to how we account for modified loans. If they're modified, in other words, if they reduce the loan payment and put part of the principal in the back to be repaid when the building is sold, we're going to pretend that it's not modified after 12 months.
When banks start reporting earnings, what are things that you would look at deeper in the weeds that other people might not be paying attention to see if this thesis is playing out?
First and foremost, you want to see if their demand for loans is increasing now that rates have been coming down. And by the way, interest rates at banks have been falling for a year. Loan rates have been falling and deposit rates as well. They don't have a lot of demand for loans, so they don't need all of those extra deposits. Also, they're getting relief in terms of bank capital rules. So again, they are releasing liquidity. They're not renewing debt. I think we'll all just assume that the Wall Street side, the trading and investing side of most of these universal banks is going to be up because the markets are pretty robust. And then the real issue for the future is credit. Do we see them starting to put away more reserves because they think that loan losses will be higher next year? And one important point to make is that the Trump administration has rolled back all of the special treatment that we had during COVID for forbearance, for loan modifications, everything else. That's done as of October 1. So you're going to see the cost of credit, especially consumer credit, much more visibly than we have over the last 5 years. And that's going to be something I'm definitely watching for because that'll force the banks to start to put away more money.
You say the cost of credit. You mean that in a classic, when the tide goes out, you see who's wearing their swim trunks situation. You're saying that some of the special programs that existed during COVID in the Biden administration have finally rolled off.
That's right.
And that the banks are now more kind of directly exposed to credit.
Where credit is most, I think, acute right now is the bottom quarter of consumers. If you look particularly at the FHA market, which is where low-income borrowers, first-time home buyers typically go, delinquency is in the mid-teens. There's 500,000 loans that are already underwater because of the price of the house falling. You're starting to see weakness around the country in certain home markets. But the other thing I think we got to factor into the equation when we talk about banks and demand for credit is that there's all these non-banks that have come into the marketplace over the last 5-6 years. If you go out and count the number of equity-funded consumer platforms that have just suddenly appeared on the scene, offering very attractive terms, that's part of the reason why banks aren't seeing the same degree of pull from consumers when it comes to demand for credit.
It seems like in banking, it's companies that are maybe outside of the S&P 500, your SoFis, Chime, which recently went public. Obviously, Robinhood just joined the S&P 500. But that's maybe why the sort of financial sector that we see in the S&P 500 is underperforming. And so do you think investors should really look outside of that at some of these smaller, more upstarty type finance companies?
Yes, but I will say this. You have to do your homework and be careful because there's going to be consolidation. We lost almost 40 banks last quarter because of mergers. These are very small institutions typically. But that's going to continue, both in banks and in non-banks. It's a network model. You want to see how many people you can attract to your network and keep. So Rocket merges with Mr. Cooper. What is that about?
Those are two big
lenders, mortgage shops.
Yeah.
But they are creating a network, millions of customers inside their wall. And indeed, over the next, a few years, a lot of their new volume, new revenue is going to come from their existing customers. JPMorgan. Same way. They have a very high-end customer, but again, the model is the same. They want to keep those assets inside the bank. They want to provide all sorts of services for that customer so they don't have a reason to leave.
And so what does consolidation mean for investors? Does that mean that some of your bank stocks might be bid up because somebody's buying them and paying a premium to buy them? Or is that a risk to you as an investor?
In an industry where you don't have a lot of organic growth, that's one of the few ways that you can get growth. So a lot of CEOs or some will use M&A as a way to grow earnings, and they may be destroying value while they're doing that. As an investor, you want to really be focused on how does this bank make money? How do they manage their assets? Take a look at the information you can get from the Fed about the different bank holding companies as performance reports that they publish. And that'll show you how they compare with their peers. That's the most important thing you need to know about a bank.
Chris, you and I have talked about mortgages and home loans for a long time. What's your outlook in that part of the business? We know that mortgage rates have come down a little bit lately, but they're still not low by any means. Is that enough to boost banks' businesses here? And where do you see mortgage rates going? Are they going to keep going down, or hard to say?
Well, the first thing you have to say about residential mortgages is that this is a non-bank business. 3/4 of this business is now done by non-banks.
In other words, most people don't even go to a bank to get their mortgage. They're going to
historically, brokers have always been the ones that make mortgages. They are usually the first person to talk to the customer, and they would then get a signed loan application and sell it to a big aggregator like a PennyMac or like a United Wholesale Mortgage or even like a JPMorgan. Now, the thing about mortgage loans that most people don't understand is they don't follow the bond market. Lenders assign coupons to loans. And so since July, what happened? The mortgage industry was pushing coupons down from 6.5%, 6 7/8, down almost 6% in the end of August. What was going on? The bond market wasn't moving that much. Lenders were trying to get in front of a Fed rate cut so they could capture more of those assets. And they were willing to take a loss on those loans early on in order to keep the servicing assets. So in other words, they sell a mortgage note to an investor in a mortgage-backed security, but they keep the servicing because they get paid 1/4 point a year to take care of your mortgage.
So it seems like everybody agrees that the Fed is probably going to keep cutting. What impact will that have across financials? What does that mean for banks? What does that mean for these mortgage companies? Is that good or bad ultimately for their economics?
For the banks, it's going to mean higher volumes, but for most of them on the commercial side, in other words, banks lend money to the non-banks who are going to make you your mortgage. The banks tend to want to do wholesale business, and they'll let the non-banks and the brokers deal with the direct-to-consumer exposures. What I think banks really want to see is higher commercial loans. They want to see more demand from businesses. They want to see more demand from any range of commercial borrowers. And ironically, who are the biggest borrowers today? It's the fintech companies and the funds. Loans generally are growing about 2% a year right now, but the loans to the funds and the fintechs and everything else growing 15% a year. And that's causing a number of people some concern. So I think, if we see rates fall, hopefully it's going to be helpful across the board for banks. But the one thing to remember is the Fed's a net seller of mortgage securities right now. They're letting their portfolio run off.
The bonds that they bought during
That's
COVID.
right. And what that means is that the banks are essentially facing, and the non-banks too, are facing higher spreads. The difference between that kind of average yield between the 7 and 10-year Treasury and a mortgage coupon today is almost 1.5 points. That doesn't help. During quantitative easing, when the Fed was buying all those securities, it was less than 1 point. And so I think for a lot of investors and also a lot of lenders, those wide spreads that we see today in the loan market are quite extraordinary, because then you look at the rest of the market. You look at the corporate bond market, where people are able to borrow money
very cheaply,
extremely cheap. So the real, I think, headline for this whole conversation is there's still a dearth of duration out there, a dearth of paper for banks to buy for investments. And they're also having trouble creating more to meet the demand from investors. And it's a global demand. This isn't just investors in the United States. This is investors all over the world.
All right. When we come back, we've got one more question for Chris Whalen. Welcome back. Chris, what are one or two indicators that you'll be looking for when the banks report earnings? What are the most important couple of things that you might be looking for?
First and foremost, we want to see how much exposure they have to the equity markets. That's a big worry. The equity markets have managed to import risk not only into the banking industry, but also into the insurance sector. So if the markets suddenly reverse, if we start to see a sell-off it's going to impact banks much more than it has in the past. The other thing, of course, is just basic funding and deposits. As we saw with Silicon Valley Bank, if you get a surprise, if you get a period of stress, the deposits can walk out of the bank overnight. And again, that is something which I think we still don't fully understand, but I do worry about, because if this market corrects, it's going to hit the funding of some of the biggest banks very hard.
Chris, I think you make a really interesting point about looking at the equity markets, meaning, the prices of stocks have gone up. And I don't know if people appreciate enough how good that's been for the business of a lot of banks, investment managers. Higher stocks means they're making more money. There's a bigger pool for them to earn fees on. And so that reversal has some risk for banks and other financial companies.
It definitely does. And banks are more comfortable being lenders to businesses than they are to consumers. But lending to businesses also has a lot of risk.
Do companies' high stock prices make it easier to lend to them?
Of course.
So again, a stock correction there would also be a risk to commercial lending.
Very much, especially if they're using the stock as collateral for the loan, which is very often the case, especially in private equity and private credit. The whole pretext for the private credit boom in the past couple of years is higher stock prices. So if we don't have that, then all of a sudden the rationale for that market goes out the window.
Wow, interesting. Well, it all comes back to watching the S&P 500 and the stock market. There you go. Easy enough. All right, Chris, thanks so much for joining us. This has been great.
My pleasure.
They use trick lighting to make us look, 20 years younger.
More
more attractive. Like there were two cool people sitting here having this conversation.